The US stock market had a relief rally yesterday on the backdrop of Trump rhetoric again, pertaining to the relationship between US Iran, where he proclaimed that a potential final peace resolution deal is round the corner. The US dollar turned south yesterday on the backdrop of this news, reinforced by oil prices plunging by 5%. Very interestingly, the Fed Funds futures market did not price in such potential retracement of stagflation risk, as right now the Fed Funds futures market continues to look for a potential interest rate hike by the Fed to come in at the end of this year. Very good morning to all and welcome back to today's Daily Dose of Market Insights. Before we kickstart today's gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So in the last 24 hours and in today's early Asia session, there are very interesting movement in the markets. As usual, things are very volatile, pertaining to two key risk events that has taken shape in the last 24 hours or so. Number one will be Trump's rhetoric and as well as the share price performance ex-post NVIDIA earnings. All right, so let me touch on these two aspects first and other related news flow before we jump into the second segment of the Daily Dose. Okay, let me share my screen here. Okay, so let's take a look at what has taken shape between the latest US-Iran relationship over here. Okay, so what we could see over here is that there's actually to and fro between the key stakeholders in this game of poker over here. So US President Trump told reporters during the sideline of an event yesterday that US was in the final stages with Iran. All right, so basically he mentioned final stages. Market view it as a very positive tonality that sparking investor hope to see we call it a bounce in the risk asset yesterday, given that we know that the US stock market has fallen by 3 consecutive sessions, where in the near term it lead to some kind of intraday oversold condition. So with this little remark that sparked a minor bounce on the US stock indices and also saw a fall in gold, in a fall in oil prices as well by -5%. But what interesting over here is that despite these final stages remarks made by Trump, Iran did not offer something so rosy, saying that Iranian president insisted that the country was not on the brink of giving in over here. And also, Iran also mentioned that they will. Okay, where's this remark over here? Yes. So Iran also warned that it would retaliate beyond the Middle East if the US or Israel renew strikes over here. So there's a lot of, we call it conflicting news, we call it flows surrounding this US-Iran current relationship of a game of poker. But for sure, right now is that the key things that if the Strait of Hormuz still remains shut, okay, virtually shut over here. And what's interesting is that we're going to take things one step at a time in terms of key levels to watch over here. So despite yesterday the push up in the US stock indices, all right, so yesterday the US stock indices push up again, and the S&P gained by 1%, the Nasdaq gained by 1.6%, and the Dow Jones gained by 1.31%, the Russell gained by 2.56%. And all this rally in the US stock market has been led by this US semiconductor industry. We call it the SOX, okay, the semiconductor index. So SOX gained a whopping rally of 4.5%. Then right now, let's take a step back and take a look at things from a intermarket perspective. Yes, despite we see a rally in the US stock market, but the Fed funds futures traders is not pricing in a all-out clear signs that this rally may continue for a multi-week perspective. So if you look at the Fed funds futures market right now, they are still continues to pricing a rather hawkish Fed coming into the end of this year. So this is the CME Fed Watch 2 based on the latest pricing by Fed funds futures traders, not live, but about 2 to 3 hours delay. So what we could see is that the current Fed funds rate at 3.5% to 3.75%. So despite yesterday's Trump's rhetoric that causes oil prices to plunge by 5%, but the pricing by Fed funds futures traders does not really shift the pendulum to a dovish Fed. So they are looking for still a hawkish Fed coming into the last month or last few months of this year. So by the end of this year, that means the last meeting of this year, which is on the 12, the December the 9th over here, market is still looking more than 50% chance. So it's at 62% chance they are looking for a hike coming into that meeting itself to bring it back up to 3.75% to 4%. And this probability continues to increase into the first 3 months of next year. So on January 27, 2027, 74% chance. March 17, 2027, April 28, 27, more than 90% chance, 98% chance, and 92% chance. So what we could see over here is that the Fed funds futures traders does not believe that at this juncture there could be a swift reopening of the Strait of Hormuz. And despite this swift reopening, the normal oil flow, the Middle East may not return to normal conditions so soon, i.e., stock oil prices may continue to remain elevated at around the $90 to $100 per barrel. All right, so Fed funds futures traders does not buy into the stock market rally yesterday. So this one, so there's this intermarket disconnect. So giving me an opinion that yesterday's stock movement rally is more like a relief rally than the start of a bullish impulsive up move from a multi-week perspective. Now back to the US dollar. Right. So if you look at the US dollar, yesterday it also managed to decline. But what we could see over here is that in today's Asia session, the dollar starts to go back up again. All right. So if you look at the 1 day performance, the US dollar has managed to stage a rally. All right. What you could see at 9 a.m. Singapore time, all right, at the start of the Asia session, there's this rebound in the US dollar. So with this rebound in the US dollar, it means that yesterday's rebound in the US stock market, it's also not leading to a potential start of a bullish impulsive up move. It's more like a relief rally instead. And now let's take a look at the share price performance of a key catalyst stock, which is the AI juggernaut NVIDIA. So why NVIDIA is important? Because NVIDIA is being used as a barometer of the current AI super cycle, especially we start to see a build up by hyperscalers using NVIDIA cutting edge chip to build AI capability models. So they are kind of a barometer to give us an indication whether the current rampant rally in AI slash semiconductor stocks are able to maintain the last 6 or 7 weeks of steep rally or not. Yes, Nvidia managed to smash expectation. All right, the earnings revenue, especially the one that coming out from the core revenue driver data center, nearly doubles. All right, so it's a very very strong earnings report and a strong earnings guidance. But the stock slides very interestingly. So what I could see over here is that Nvidia share price actually plummeted in the after hours trading. It dipped down to negative 1.3%. So apparently there is some macro factor that is coming in to override the firm specific positive factor that is driving Nvidia. So we know that share price, there are two kind of factor that is driving. One is individual firm-based factor. We call it firm-specific factor, which is earnings drivers, and macro factor. So apparently there's some macro factor that is impacting Nvidia share price movement, despite the fact that it managed to post very strong earnings result, post better than expected revenue guidance, but that doesn't cause the after hour share price to rally. All right, it actually slide 1.26%, right? Negative 1.26% instead. So net overall, what it means that macro factor, there's some negative macro factor that could potentially prevent the start of a bullish impulsive up move in global stock indices. So this is the kind of intermarket correlation that I try to actually express for you guys over here. All right. Then what we could see over here is in terms of the what you call it, the data at the start of today's Asia session, we see the Australia labor market data that is coming in weaker than expected. All right, so let me very quickly go back to the Australia data. Okay, where is it? This is the one. All right. So in terms of the unemployment rate in Australia actually plunges to negative. All right. So market was initially looking for a lower gain of jobs added 17.5 in April, below 23.3K, but it actually showed negative jobs change. That means instead of more jobs added, there was less jobs being added, negative 18.6K for April. And also the unemployment rate jumped as well from 4.3% to 4.5%. So that's indicate also potentially stagflation risk in the Australia economy. And if you look at the leading PMI data out from Australia compiled by the S&P Global for the month of May, services also contracted. All right. So the services PMI, previously it was 50.7, it contracted to 47.7. So anything that is below 50 is showing signs of contraction. So what we could see over here is that based on these two key data out from Australia in today's early Asia session, that also indicates stagflation risk in Australia itself. All right. So that actually also gives me a view that whatever rally that we see yesterday is more like a relief rally in risk assets. Okay, so that's pretty much sum up the first segment of the daily dose. So now let me move on to the second segment where I'll share with you various interesting technical configuration on the intraday basis based on a few selected cross asset classes that I deem is pretty much interesting to keep a close eyes watch on for today's trading session over here. So the first one I'll touch on will be in the FX market. All right. So before that, let me expand my screen. So hopefully that little circle at the top right corner will remove this time around so that you guys will able to have a better view of the charts. All right. So I think it's gone. Okay, good. So let me now share with you the chart of the euro dollar, which one the spot highlight on the share. Right. So the euro dollar, what we could see is that in today's Asia session, there's a bearish reaction off exactly at the 50-day moving average. So previously on Monday, we do have a bearish bias. So bearish bias hit close to our support level around the 115.95, 116 figure level before bouncing in yesterday's US session due to that Trump rhetoric. All right, over here. So with that, I will now have an adjusted short-term pivotal resistance down slightly from 116.85 to 160.60, which is not yesterday, pardon me, Tuesday high. All right, Tuesday high, which is just slightly above the 50-day moving average. All right, and also today's the intermediate resistance will be at 116.35, today Asia session high that got rejected so far. Maintain intraday bearish bias on the euro dollar. First intermediate support level to watch will be yesterday's European session low or London session low at 115.85. Breaking below 115.85 will now start to see floating down potentially to a crucial support level at 115.55. So why 115.55 is crucial? Because if you were to look back in time, it's actually the medium-term ascending trend line drawn from the low of 13th of March. All right, so that's coming close to a 2 months plus of trend line. Okay, ascending support trend line. So by breaking below this ascending support trend line at 115.55, that could invite more potential weakness to come into the euro dollar for the next near-term support, next intermediate support to get exposed at 115.10, which is the minor swing low area of 2nd of April and 6th of April. All right, so this will be the key levels to look out for. 116.60 to maintain today's intraday bearish bias on the euro dollar, 160.60. Only a bullish breakout above 160.60 will negate this bearish buy. Okay, I'll repeat again. I think it's a bit tongue twisting. 116.60 short-term pivotal resistance level, a tighten one to maintain that bearish buyer's view. Two key near-term support level to watch: 115.85, 115.55. Only a bullish breakout above 116.60 will negate the bearish buyer's view to see a push up to retest the important 200-day moving average, confluencing at 116.85. Only a break above 116.85, that means the hourly close above 116.85, may trigger a mean reversion rebound scenario towards 117.20, which is coming very close to the 20-day moving average as well. All right, so that's for the euro dollar. Next one I will share with you guys will be the Aussie dollar, which is pretty interesting. After we see it, how does it react from the release of today's key relevant Australia leading economic data. So the Aussie dollar can't break above the 20-day moving average. So it did a bearish reaction of it. And also the bearish reaction of actually took place at exactly at the upper limit of this minor descending channel that has been in place since 14th of May over here. So with that, I will use 71.80 as my short-term pivotal resistance level. Bearish bias for today. First support level to watch will be at the 50-day moving average, where it managed to survive yesterday, 70.85. So if we start to see a breakdown below 70.85, then I will use the upper boundary of this minor descending channel as my short-term pivotal resistance. That means I will shift it downwards to 71.50. Below 70.85 exposes 70.55 followed by 70.30, which is also the lower limit of this ongoing minor descending channel. And also 70.30 is the minor low of 13th of April. Only a bullish breakout above 71.80 will invalidate today's bearish buyer's move on the Aussie dollar for a squeeze up towards 72.33 level. All right, over here, 72.33. All right, so still maintaining a bearish buyer's view using 71.80 short-term pivotal resistance, which is confluencing with the 20-day moving average for the Aussie dollar. Next up will be the stock indices that I want to highlight will be the Hong Kong 33 that is representing the Hang Seng Index. So the Hong Kong 33 did a bearish reaction exactly right at our short-term pivotal resistance that we highlighted yesterday. 70, okay, let me do a proper one. Remove this. 25,850. All right, 25,850. So 25,850 is indeed a key inflection level that prevents the short-term bulls from taking charge. So still watching 25,850 given this strong bearish reaction at the start of today's Asia session since 9 a.m. Singapore time. 25,850 short-term pivotal resistance, maintain a bearish buyer's view on the intraday basis on the Hong Kong 33 that is representing the Hang Seng Index. First support level to watch will be 25,470, followed by 25,267, which is the gap up support level that has been formed between 3rd of April and 8th of April. All right, only a bullish breakout and an hourly close above 25,850 that would invalidate today's bearish buyer's view to see a squeeze up towards 26,210, maximum 26,435. All right, so this is the stock indices that I want to feature today, which is Hong Kong 33. Then onward next will be highlights on the major US stock market, given that it's also very important in terms of its leading sentiment feedback loop behavior. So the US Wall Street 30 squeezed up above our Titan short-term pivotal resistance yesterday and hit the upper limit of this ongoing minor range resistance since 7th of May. So with that, we will now flip to a neutrality stance on the US Wall Street 30, neutral between 50,035, 50,145, and the lower limit of the range will be at 49,070. So flipping to a neutrality stance between 49,070, lower limit, upper limit 50,035, 50,145. Next will be the SPX 500. So the SPX 500 also managed to bounce off from our first support level after retesting it during the Asia session until 12 p.m. yesterday before it did a rally from throughout the London session and in the US session. And right now it's coming to face a kind of a bearish reaction. So it did a bearish reaction in the last hour of the US trading session, just right below the 7,460 short-term pivotal resistance that we highlighted. So with that, still using 7,460 as my short-term pivotal resistance level, maintain a bearish bias view on the intraday base for today. Two key support level to look out for will be 7,386, which was yesterday's minor congestion area that is being formed during mid-London session and also at the start of the US session. Breaking below it may revisit this key downside trigger level again at 7,345. So if you start to see a very clear breakdown below 7,345, where it managed to survive since the start of this week, that will also indicate a bearish breakdown of a medium-term ascending channel support that has been in place since 2nd of April. All right, so breaking below 7,345, that will increase the probability of a multi-week corrective down move sequence that may unfold on the SPX. However, if you start to see a bullish breakout above 7,460, that would invalidate today's bearish bias view to see a squeeze up to revisit the current all-time high area at 7,522. Lastly will be the Nasdaq 100. So the Nasdaq 100 also did a bearish reaction of the short-term pivotal resistance that we highlighted yesterday, 29,400. So what I do is that using 29,400 as my short-term pivotal resistance, still maintain a bearish bias for today on the Nasdaq 100. First support level to look out for will be this congestion area that is being formed during the start of the US session at 29,000 figure. Breaking below 29,000 figure will potentially retest the all-important downside trigger level at 28,660, where it managed to survive on Tuesday US session. So if we start to see a breakdown below 28,660, that would potentially open up scope for further potential weakness towards 28,460, 28,280. However, if you start to see a squeeze up and a break above of 29,400, then this bearish bias view will be invalidated to retest the current all-time high level of 29,704 over here. Next asset class I want to highlight will be an update on the Gold XAU/USD. So Gold XAU/USD also did a bearish reaction from the minor swing high that is being formed on Tuesday, 19th of March over here. So over here, this bearish reaction rejected exactly at this key area over here. And if you were to do the Fibo retracement from the decline after that last retest of its 50-day moving average on 12th of May, all the way down to yesterday's Asia session low, that also confluenced with the 38.2% Fibo retracement. So using 4,580 as my short-term pivotal resistance for today, maintain a bearish bias view on Gold XAU/USD. So the first support level to watch will be yesterday's Asia session low area at 4,456. Breaking below 4,456 exposes 4,415 next, which is the low of 27th of March this year. However, if you start to see a bullish breakout and the hourly close above 4,580, that would negate the bearish bias view to see the continuation of this relief rebound taking shape to retest 4,645, maximum 4,715, which confluence with the downward sloping area of the 20-day moving average and the 50-day moving average over here. So that's for Gold XAU/USD. Lastly will be the West Texas crude oil. So West Texas crude oil plummeted below the 20-day moving average and also plummeted below our Titan pivotal support level that we have yesterday at 103.60 thereafter. So with this bounce taking shape on the 20-day moving average, so right now it's trying to survive at the 20-day moving average by bouncing up, and technical elements are rather mixed right now over here. So what we could see is that the RSI is also bouncing off from the oversold level. So with that, we will now flip to a neutrality stance first, neutral between 105.75 and the lower limit is coming very close to the 50-day moving average, which is this congestion area here of 8th of May and 11th of May at 97.40. So neutral between 97.40 and 105.75. So if we could have an hourly close and a bullish breakout above 105.75, then potentially the bulls are back in control again for it to revisit this week range resistance at 109.35. Breaking above it will expose 112.84, which is the minor swing high of 30th of April. So that's for West Texas oil. Neutral for now at the moment, but up watching the upper limit at 105.75 to see whether the boost can actually come back to firmly control the oil prices again, at least in the intraday basis. So with that, that sum up the second segment. Now, let us now touch on what are the key economic data / events to look out for today. Let's have a quick look at the economic calendar. So today will be the Thursday, the 21st of May. So today will be Global PMI Day. So S&P Global, which is the compiler, will release their preliminary data for May across the developed nations. So starting with France at 3:15 p.m. Singapore time, 3:30 p.m. we have Germany, and the aggregated Eurozone will be at 4 p.m. So market participants will be placing a close eye watch on the services PMI data to see would there be any deterioration in terms of sentiment, and especially coming towards the US session. So at 4:30 p.m. you have the preliminary data out from UK. So the US one will be at 9:45 p.m. All right, so just 15 minutes after the US session opened. So 9:45 p.m. the US data compiled by the S&P Global will release the manufacturing PMI data and services PMI data. So market will be paying close eye watch on the services PMI data, given that services is the key driver of US GDP growth. So market consensus is still looking for almost unchanged at 51.1 from 51. Right, so if we start to see signs of contraction, that means below 50, and as well as within the subcomponent, there's this input prices. So if input prices continues to rise, both manufacturing and services, that also increase the risk of stagflation over here. So that will be at 9:45 p.m. Singapore time. So before 9:45 p.m. Singapore time, we have the very volatile tier 2 labor market data in US. We call it the weekly continuous jobless claim. So that may also have some impact on the FX market and the major US stock indices, given that that also could potentially be one of the input that US Federal Reserve officials tends to take a look when deciding their monetary policy decision-making process. So that will be out at 8:30 p.m. Singapore time. Then thereafter, we will be a rather quiet US session. So on Monday, before the start of the daily dose at 7:30 a.m., we have Japan, one of the Japan tier 1 data, which is the nationwide Japanese inflation data coming out at 7:30 a.m. for the month of April. So for core inflation rate, market is expecting a slight dip to 1.7. So that is only that is kind of exclude food, exclude energy. So if you were to actually exclude that's including energy, pardon me. So if you look at the core rate, they call it exclude food and energy. Previously, it was at 2.4%, still holding above a BOJ long-term target of 2%. So BOJ officials will be looking at this X food and energy instead of the core inflation. So the way Japanese we call it statistical board term it is a bit slightly interesting. They call it core. So the core inflation for Japan for April, trading economics forecasting it to be maintained the same at 2.4%. So this particular release will potentially definitely impact the dollar yen, and the yen crosses at 7:30 a.m. Singapore time. So since we are talking about the Japanese key data that is out tomorrow before the daily dose, let's very quickly take a look at the Japanese yen. So the dollar yen over here continues to hover below our short-term pivotal resistance level. So prior to that, the FinMin starts to issue verbal warning during the G7 meeting on Tuesday over here. So that will be a key reason to watch. 159.10, 159.35. So first support level will be at 158.35. That confluence with the 20-day moving average. All right. So with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you guys a great day ahead, and we shall speak again tomorrow. Thank you.